So when you get a chance to take a look at the pitch deck, what's the first slide that you flip to, or the slide that you spend the most time looking at?
For me, it's just the initial value prop. I mean, I hate this, but I think having a catchy one-liner is really helpful. And then value prop just helped me understand what's the problem and solution. And then it's usually the team slide after that. So this is at seed stage. When I'm later stage stuff, I have lots of things, but seed stage, that's usually the order I go. I kind of go back and forth on that one. The team can be really interesting. I've definitely looked at certain decks where I looked at the messaging and the value prop, was like, I'm not sure I really get it. I'm not sure this is really for me. And then you look at the team and it's like, okay, maybe it's worth a second look, go back and try and think about it better through the lens of who the founders are. If that still doesn't line up, then it's always a little complicated. Even if the founder seems great. But yeah, usually in that order. And naturally I go to like, what's the status of the business and everything else at that point.
Hello, everyone, and welcome to Fund It, a series where we pull back the curtain on venture capital fundraising from both sides of the table. I am Alex Wittenberg from airCFO, and we're on a mission to demystify the fundraising process for founders everywhere. This series dives deep into the tactics and strategies that actually work for closing funding rounds. No fluff, just practical insights that you can apply. We'll be hosting conversations with two key groups. First, with successful founders who will unpack their fundraising journeys from start to finish, from sourcing critical introductions to refining pitch strategies to building relationships and closing their rounds. Second, we will sit down with active VCs like our guest today to understand how they evaluate opportunities, what founder approaches stand out, and how decisions actually get made inside of their firms. Our goal with this series is to share lessons and create a playbook that helps founders and investors have more productive fundraising conversations and facilitates more efficient capital raises. And today, I'm really excited to welcome Nick Adams, co-founder and managing partner at Differential Ventures. Nick leads a data-focused venture firm that's invested in numerous successful startups across AI, machine learning, and data infrastructure. Differential has raised over $100 million across 3 funds and made over 40 investments in companies transforming how businesses leverage data to operate more effectively. Nick brings a unique perspective, having not only invested in the space for nearly a decade, but also having led software companies from the operating side that generated over $1.3 billion in exit value. He served on the boards of numerous high-growth startups and sits on the National Venture Capital Association's AI and National Defense working groups. Mouthful. I'm excited to explore some insights that founders should know before pitching to firms like Differential and how they can position themselves for success in the rapidly changing funding environment. Nick, welcome to Funded.
Thanks. Great to be here. Thanks, Alex.
I'd love to kick things off by hearing a little bit about Differential from your perspective. When you are meeting with a founder for the first time, how do you describe Differential as a firm? What's your investment thesis and what makes you stand out in the venture capital space?
Yeah, so, we have a kind of unique advantage in our world, given that, my co-founder and I have actually both spent our entire careers in the big data and enterprise tech and AI world. So I come more from kind of traditional startup background. I ran product, sales, marketing for a few companies along the way that had some really good outcomes. And my partner David is deep tech, as deep as they come in data science. He built a medallion fund for Renaissance Technologies that is a purely quantitative trading platform. Did 65% a year for 35 straight years. From a just a credibility and our ability to understand the space from kind of every component of the business. Both kind of horizontally across an organization, but also depth in terms of the growth of your startup. We've been there and we've seen an awful lot in and around the AI space for the last 25 plus years. Some good, some bad, some ugly, of course. So I think we have a pretty unique advantage that we've actually done this both as investors and operators for a very long time. And it's always been our focus. And I've sort of been forced into calling us an AI fund because it's become like the lazy way of referring to this market. But we tend to think of ourselves more as building a data-driven economy, which is a lot more complex than stuffing a large language model on top of all your data and declaring success. So we view this much more as a multi-decades-long journey of how to appropriately collect, manage, secure, analyze your data over time so you can become a data-driven enterprise. And then at scale of various network effects, we'll become a data-driven economy. So I think slightly different, longer term perspective that, obviously a very deep understanding of technology and what will work and not work over the longer haul. But more importantly, I think we've always stayed really focused on the end game of what are the business outcomes that will come from using this technology, as opposed to just saying, we're in AI. So that's a long way of saying we spent a lot of time in this space, worked with a lot of founders, and have been there ourselves, which, in today's age of trying to figure out how to differentiate and scale a startup from seed into A and beyond, comes with a lot of good learnings. And as you said, that things are changing fast. We're always learning ourselves too. No question about that part.
Thank you for the introduction. That's super helpful. Based on the long track record that your firm has had within the AI space, you were clearly here before the ChatGPT moment in 2022. I would love to talk about your fundraise process, and that's going to be the bulk of this conversation. But as a follow-up to your intro, I'd love to understand, how are you all viewing this current AI wave that we are riding, and where do you think the broader venture funding market or where do your views differ from what has become consensus with these VCs who are pouring money into AI startups today?
I think the interesting thing about the world we live in right now is that we will see companies scale faster and fall faster and harder than we've ever seen before, and that is both kind of a compliment and a tribute to the breakthroughs that we've had with transformer models and large language models and generative AI, and also a bit of an indictment of the exact same. There is certainly an advantage right now for companies that figure out how to use AI intelligently in a human way. It sounds funny to say, that can help them scale faster, more efficiently than we've ever witnessed. A lot of those same things in a, speaking of purely generative AI, large language model world, are the same things that will probably bring down some of the high growth companies of today and the next couple of years really rapidly, because there aren't a whole lot of defensible moats if your strategy is, build a UI on top of a commoditized large language model, hope that compute costs go down over time, which isn't looking great right now, and that nobody else comes up and starts chasing at your heels. But like we see in every other market, if you get to traditional world, if you get to 10 million in recurring revenue and you're the only competitor in your market, you better be damn sure there's more competition coming, and the same is going to be true in this market. I just think you're going to have such a head start for some companies that's why I think the fall may be greater for some of them as well. So I think it's an interesting time. In my experience, I've been through waves of excitement and disillusionment with machine learning and AI over almost 25 years now, and I think we've had a huge breakthrough with transformer models. And I think the best change I've seen, the most exciting change I've seen since 2022 is that everybody now knows that they need an AI strategy. And there's no getting around that. And, prior to 2022, even in our own fundraising, raising funds, like Fund 1 in 2017, 2018 was okay, I get it. You guys have a good backgrounds, complementary data, AI, sure, things are probably heading that way. Don't know over what time frame. Then there were a couple of years, 2020, 21, the bubble years where everybody was kind of isn't AI done? Why aren't you guys in crypto and metaverse and whatever? And then after the 2022 explosion, my IQ must have gone up 15 points. I got better looking overnight. I got funnier. I got invited to all the cool parties. All of a sudden, AI became super hot. And the one thing that is really, really sticking with that is that everybody needs to figure it out. And that's just good for our portfolio companies, good for our thesis and experience in the market. So that part's been positive, but it's definitely been a lot of frustrating changes along the way too.
Yeah, absolutely. I imagine y'all probably went from being big data focused to probably being machine learning focused to finally like where you've landed today being like the AI venture capital firm. So yeah, you guys were a bit early to the party, but everybody is caught up at this point.
I have to say big data now because it's the equivalent of saying you coded in Cobalt or something. And we're only talking about 10 years ago, 15 years ago, where that was the, kind of the main term, verbiage we use in the venture and startup world. So I'm starting to feel like a dinosaur.
I really resonate with your point, though, about the rapid scaling of some of these AI startups. I mean, I'm sure you've seen the chart of the number of months to $100 million in ARR. And it seems like every month there's a new company that's like setting the bar higher and higher in terms of the speed to 100 million in ARR. But if it's that easy for a company to go from 0 to 100 million in 7-8 months, you have to wonder if there is going to be like a defensible moat there, or if someone else could come along and sort of unseat them. So it sounds like you're a bit hesitant to jump on when you see a company that is, well, it's obviously good if you get them before they go 0 to 100 million in ARR, I suppose, but you're not necessarily chasing the bright, shiny objects that are coming onto the scene here when it comes to building these AI-powered like LLM wrappers.
And look, I say this as somebody who firmly stands behind our thesis and what we think is going to work in the long run in this market, from market perspective and technology perspective. And also speaking as someone who, I part of me would love to have OpenAI in our portfolio or Anthropic and have these, crazy markups to talk to. If we were in there at the seed stage, that would be great to talk about. Especially as an early stage investor, I'd probably, by this point would have sold every red cent I possibly could have in secondaries. But it's just, our mantra has always been like, we are not looking to compete at the model layer. It's really not going to be our specialty, not really where we think you're able to differentiate that much over time here. So a lot of our approach is what probably sounds a little bit boring, but is really based on a hybrid AI approach, which is kind of classical machine learning, AI, data science, and just good old engineering, in use cases of the consequence, which I can explain, and then using generative AI tools as kind of the the nice veneer and kind of interconnectivity between different data sets that it's really good at. But I think at the very core of the architecture and the way we think about this is no meaningful use case is really able to use a black box model for the underlying architecture. Like if you're a high frequency trader, if you're manufacturing, healthcare, financial services, like any time like you're using AI to make decisions, so predictions basically, large language models are oftentimes the least efficient way to do that. They don't have a whole lot of explainability. So you can't really tell what data sets they've been trained on, which makes it hard to understand why the model is hard to change them as they may drift over time. So they're just not usable for like the core decisioning of the algorithm. We tend to overinvest in those use cases, which is not as sexy of a sounding thing as or value proposition as AGI. Right. But technically, we know these will work. We know why they'll work. We understand why our portfolio companies' customers need those other features, I'll call them, of explainability and transparency. I think that's going to have the longer term defensibility here in the AI space at the applied layer. Obviously, still looking at tools to just upskill what's available at the data science, machine learning tool set, kind of the platform level, and then deeper tech, always looking at things around high performance computing, even dabbling in the quantum, data privacy, cybersecurity, all the stuff that enables data processing and AI.
Awesome. Yeah, it makes a lot of sense. Let's shift gears for a minute and talk about Differential's investment pipeline. I'd love to walk through step by step from first meeting to term sheet. But before we even get to the first meeting, could you give us an overview of, just to put it into perspective for people, how many pitches or how many companies do you look at on an annual basis? And how many first meetings do you take? How many do you progress forward into more of a deeper diligence phase? And how many do you end up investing in a typical year?
We typically see somewhere around 5,000 per year. And, off the bat, about half of those are just out of scope for us. We, as you can imagine, we like data. So we have processes for kind of tracking everything that comes in, getting into our data lake. But usually about half of them are kind of consumer or too late or too early or geographically misaligned, just somehow out of thesis, right? So we cut that down pretty quickly, call it 2,500 that somebody needs to spend a moment thinking about. And we've built automated tools. We use Harmonic and HubSpot kind of in our core tech stack there to do some automated decisioning for our inbound deals. And then if it passes our criteria, then it ends up in HubSpot, where somebody spends time on it. From there, we usually have, we meet with between 15 and 20%, usually, of the 50% that get through the kind of just baseline across our team. From there, it drops down pretty quickly, right? So we get from, call it somewhere around usually between 750 and 1,000 meetings a year across our team. And we usually end up putting about 50 into what we call our light diligence phase, which is, typically we've gone through, let's call it 2 meetings with, basically understanding the business side of things, getting a feel for the technology. And if that all kind of lines up, then we start doing a little bit more work on the market, the founders, and the competitive landscape, and start forming a better thesis around what we would need to believe for this to be true. We're big framework people, so we have a bunch of different frameworks we start, filling out kind of from day one. But at this stage, we really start thinking through all the things we need to believe and figuring out where the holes are in our just basic information and also our knowledge and understanding, and start putting together a work plan for how to go figure those things out. Or not. Sometimes we get to a certain point where we're like, this, we go pencils down on it. So call that about 50 or so per year. And then we usually end up investing in somewhere between 8 and 10 net new investments each year. So it's a pretty steep funnel.
Yes. From 5,000 opportunities down to 10 investments in a given year. That is pretty low acceptance rate.
It's a pretty low acceptance rate. Yeah.
Are those 5,000 companies, are those all inbound, or do you do some level of outbound prospecting as well?
A lot of it is inbound. We have built up a much more robust outbound process over the last couple of years. Invested quite a bit in technology and people to do this. So we're at the point where we issued our first term sheet end of last year off a company that we purely source from our outbound efforts. And it's been good. I'd say we're in I'm a washed up baseball player. I use a baseball analogy. We're in the 3rd or 4th inning of where I'd like to be on this front. But it's getting a lot better. And we sort of made a conscious decision not to build something overly proprietary in-house. And we've been building this on top of Harmonic and a couple of other tools for 4 or 5 years, just kind of fine-tuning the data and what we like to see. So it's at a good point now. I'd say our highest quality deals over the next couple of years will most likely come from our outbound effort.
It's really interesting. Investing at a certain level is a sales discipline, and I know you have a growth background yourself. So I see how you got from where you were at on the operating side to building out the outbound funnel, and I think it's probably becoming more and more important over time as the number of VCs is increasing, and you want to get onto the radar of these companies at earlier and earlier stages. So that makes a lot of sense. For the companies that you discover through inbound engagement, what are some of the best ways that a startup founder can put themselves on Differential's radar? And as a related question, what's the most unusual path that a founder has taken to successfully getting onto your radar and getting a meeting with y'all?
Okay, I think that the key word there is successfully. The weirdest way was definitely like following me into the bathroom at a conference, which was an approach. I don't recommend it, but it was an approach for sure. It wasn't successful, as it also happened to be just like out of scope for us, but it was definitely a little bit of an invasive entree into the company. Most successful, honestly, like the reality is that just a thoughtful human email into me or into somebody in our team works really well. Somebody here looks at every single deal. We can't possibly respond to everything, but we have countless times where we just get a good cold email. Saw you invested in these companies. We're similar because of X, Y, and Z, or relatable because of X, Y, and Z. Here's our background. That works great for me, to be honest with you. LinkedIn's tough. It's just such a messy system of organizing messages, and I get so much garbage in there that's harder to filter out relative to my inbox. I've just kind of struggled with that. I keep up with it, but it's just not. It's kind of unruly in there. But yeah, honestly, just a thoughtful cold email. Applaud people who go the extra mile and try and get a warm intro. It's been beaten into founders' heads over the years, and it is super useful sometimes. And I think it's useful in probably securing a meeting, but I'm not sure it's always good at getting the highest quality meetings. And I say that because venture historically and still today is just kind of a very social network. You have lots of weird dynamics of different people trying to impress one another or keep each other happy or whatever. So a lot of times you end up getting a meeting, even if the person you're pitching really isn't sincere about it, because they're trying to build or maintain a relationship with whoever sent over the deal. I'm not discouraging the approach, and I think as an investor, one of the things we're obviously evaluating a founder, just your ability to network and sell and get meetings and get deals done. So it's like a bonus, definitely plus 10 points on that front. I think if I was a founder, I wouldn't rely solely on doing that, because I think you might end up spending time in meetings that just aren't going to have as high of a close rate as you think it will. And I have the same thing for me with when we're fundraising. I get lots of intros to LPs, but if the intro is from somebody who's not writing a check into our fund, it's not super high quality. So it's good networking. Maybe they'll invest in Fund 9 or something like that, but it's usually not great for we're closing this round or closing this fund on X date. Need to work backwards from this right now. I think that's a little bit more complicated.
It sounds like y'all do a lot of enrichment of the opportunities that you see coming through. So maybe that allows you to be a little bit more objective with the source of the opportunity, whereas maybe other VCs will lean a little bit more heavily on referrals because they just don't have the capacity to evaluate all the cold emails that come through or whatever it might be. Because it definitely is at least what I hear from founders most often is that sending a cold email to a VC is sort of an effort in futility. But that's good to know that founders can reach out to Differential, and if the pitch stands on its own without the referral, that they'll be able to have a conversation.
I mean, I to put it in some context, I had 3 meetings this week that came from purely cold inbound to me. I was traveling most of last week. So like most of these were emails from 2-3 weeks ago that just got into the calendar this week. But and one of them was amazing. Like I've got, basically putting into a full team meeting on Monday after I met with them yesterday, which is not, that's a good sign that I really liked, the first meeting. So yeah, it definitely works. And look, I don't know the exact number off the top of my head, actually. Probably 10% of our 5 or 10% of our investments have come from just pure cold inbound. But I think it's also because, the market's just been programmed so much to do this other stuff. And lots of things that we have done are just things that have come through like another incubator or accelerator or angel investor that we know and we track. So there's just like, it's almost like outbound for us at that point because we know what we're looking for. We know how different, groups think and why that may or may not align with us. So it is a decent filtering mechanism in some ways. But it's not always like a, warm handoff connection. It's more like, hey, saw you went through Forum Ventures or had this angel investor on your cap table. Thought we should chat.
When you come across a startup that you would like to have a meeting for or with, what are the materials that you want to see ahead of that first conversation?
First conversation, not that much, to be honest with you. I like seeing, the deck. We have a process for just kind of like extracting the information we need to have out of it. But I also just like seeing how companies present themselves. Like, how do you market? What types of tools did you use to create the presentation? Are you in PowerPoint? Are you in Canva, or is it done in Canva? Like, some of these things are interesting, just to get a feel for the mindset and ability of messaging and marketing and sales by each founder, and then just kind of like a brief intro paragraph. That's all I really want going into a first meeting. Usually I start after intros and all the normal stuff, just kind of jumping into like, all right, what's the value prop? If I was your customer right now, how would you pitch the product? I get a lot more value out of that than kind of like I was born down the street from Steve Jobs and all that. Typically like to get to the, like, what would you say to your customer right now if you were trying to get us interested in using your product as a customer?
Yeah, I could see that being a really strong signal, especially at the early stages, because a lot of times it is the founder who's doing the sales. And so if they can convince you that the product that they're selling has value, then they probably have a pretty good shot of convincing their customers of that as well. So when you get a chance to take a look at the pitch deck, what's the first slide that you flip to? And or the first slide, or the slide that you spend the most time looking at?
Yeah, I think it's for me, it's just the initial value prop. Like, do you have I hate this, but I think having a catchy one-liner is really helpful. And then sort of value prop, just help me understand what's the problem and solution, right? And then it's usually the team slide after that. So this is at seed stage. Like when I'm later stage stuff, I have lots of things, but seed stage, that's usually the order I go. So I kind of go back and forth on that one. The team can be really interesting. Like I've definitely looked at certain decks where I looked at the messaging and kind of the value prop. Was like, I'm not sure I really get it. I'm not sure this is really for me. And then you look at the team, and it's like, okay, maybe it's worth a second look and kind of go back and try and think about it better through the lens of who the founders are. If that still doesn't line up, then it's always a little complicated. Even if the founder seems great. But yeah, usually in that order. That's it for me. And then naturally I go to like, what's the status of the business and everything else at that point. But when I think about putting together our own presentations and when I look at any pitch deck or advise founders, it's like first 5 slides don't have like, what are you doing? Why is it important? Who are you and why are you qualified to solve this problem? And like, what are your proof points to that? Then I think it's, sort of a -5 on the messaging and marketing front. And it's happened. Like I've gotten the, slide 43 in some deck that I'm pretty much glazed over on and see, incredible traction or badass founding team that I wasn't really, thinking about in the context of the rest of the deck. And I'm like, how did you bury this in the appendix? Like, this is the story, you know? So yeah, I think that's where I spend most of my time in the kind of initial review, at least.
I imagine that some of the founders that you're speaking with are like very much engineering oriented or data oriented. And so they have a superpower in that area, but may not have a superpower in the sales and marketing side. And so if you find a great team, you can maybe coach them up or, you know, help them find someone to slot into that seat to help them polish up their story. And so that can, I could see that like making up for the lack of necessarily like the super put together and like seed stage pitch deck.
Yeah, it's look, been there. It's harder than it sounds. The thing I tend to look for in that situation is do they respect the process of discovery and sales? And a lot of people don't. I spent a lot of my career in the sales world and worked with a lot of engineers and marketers and professional services people who, you know, thought they could go out there and get deals done. And, you know, it's really hard. It's extremely hard. So I in one of my favorite companies and like stories in like an early, like a pre-seed investment we made, a company called Private AI up in Toronto. They've done great. They've raised Series A. But in 2020, we put in their first pre-seed check of like $200K. And they super technical team. Patricia was technical. Peter, the CTO, was technical. And I was doing a Saturday morning Zoom with Patricia and her like 2-year-old son at the time. And I was like, so, you know, tell me about sales. Like, what are your views? Like, what do you think your strengths and weaknesses are? Where do you need help? And she was like, you know, she's like, I don't know anything about sales. She's like, that's why I'm hoping you'll invest in our company so you can help us out. And it was the best answer I could have heard because it was honest. And you know, what I learned was like she learned selling and how to build a pipeline like an engineer, right? Like, you know, very procedurally, and you know, you could kind of fill in her blind spots a little bit from kind of the qualitative just sales side of things with how to recruit and then hire her first salesperson who was like not your typical, you know, Salesforce, Oracle trained person. But he came in from kind of an unconventional background, which tends to work best when you're asking somebody to come into a company with like no product, no market, no brand name, and just start selling. Like you kind of have to be a bit of a Renaissance salesperson, is usually what I call it, and not too much of a process oriented person yet.
Right. Yeah. There's no playbooks at a pre-seed. Yeah. What I'm hearing from you there as the takeaway is that a founder should be transparent or at least mindful about the competencies that they have and not try to gloss over a gap that they may have in one area, but more so like leaning into their superpowers in the area that they are world class in, and being like owning up to the fact that, hey, we still have these areas that we need to improve, but with your partnership and your funding, like we can help to close those gaps. Is that kind of how you think about it?
It totally is. I think it's just it's a better starting point for everybody, because when we're asking questions, when we're doing our diligence, we're putting together our frameworks, everything else, like what we're getting to is not like a gotcha question of like, you know, yoink, now I'm going to pull my term sheet. We're assessing risk, and every single startup has risk at every stage of their development and growth. They change over time. The problems that I'm solving at a seed stage company are a lot different than the problems we're solving at from still on the board at Series C. So for us, we're good, I think, assessing risk in founding teams and markets, and our job as investors and washed up operators is to help founders kind of get ahead of those issues and try and avoid them or make them softer landings, as opposed to like brick walls. And so that's really it. It's the more it can be a collaborative effort, the better. And I think it's also true from our side of like, it's hard to fool us, by overselling yourself in certain areas. We just have too much experience, but there are also times where like I can't help. I always look for like the number one thing I can do for a seed stage company is help build pipeline, right? If I can open up the door to a bunch of customers, and that's a win. There are times and there are markets where I can't guarantee that we're going to be able to do that, or I just know it's not ready to go to our network quite yet for like sincere sales pitches. So I think for us, it's also just like calibrating where our holes will be in kind of supporting the company as well, and figuring out how to plug them through a combination of resources, either elsewhere in our team or the founding team, or in hiring and outside partners.
Shifting gears a little bit, how do you evaluate market size and competition when you're looking at a potential early stage investment?
We probably spend more time than most seed funds on this, maybe too much time. I don't know, but we, from a market sizing perspective, I don't want to say that we're super rigid or we have a hard and fast rule. It has to be a $5 billion market or more for us to get interested. Obviously, that stuff helps, but the reality is at the seed stage, if you can solve one problem really, really well for somebody in a market that is underserved, and we can verify that there are enough users in today's world to get some organic growth going. Users actually isn't always the right metric. Sometimes it's users, sometimes it's devices, sometimes it's usage. But if we can believe that there's enough there as a kind of entry point. And then secondly, if you can expand that market based on opening up new opportunities by enabling new features, functionality, whatever, that's great. So I view our job more so as like, how far can the initial use case, like if we're really good at X today, and feasibly at the seed stage, you can only be good at one to two, maybe three things. If we're really good at 1 to 3 things today, does that get us to 2 million in recurring revenue? Does it get us to 200 million in recurring revenue before we have to like really start thinking about broadening the solution set and tackling more of the market and going after potentially more entrenched competitors that maybe don't have as complete of a solution? So that's more how we think about it than just like, boom, has to be a $10 billion market today. So I don't know how you even really think about that at the seed stage. So that's where we spend most of the time, and that definitely varies based on the market that the company is selling into, market or markets, and also where you are in the tech stack. So tech stack has sort of like an inverted issue of when we're investing at the applied AI layer. We pretty much know who the customer is going to be, what the value proposition is going to be, more or less what budgets can be in the early days. Typically thinking about like a land and expand over time, but we roughly know that. So that's where it's easier to be like, okay, this gets us to 20 million if we're really good at it. And then we have to start thinking about what's next. Or deeper in the tech stack, if you're at a down at the compute layer or elsewhere, or private AI is a good example. Like they can be selling into lots of different people, and the challenge there, once you get to scale, the world's your oyster. But the harder challenge there is like, all right, how do we get to our first few use cases of repeatable sales that'll have a little bit less friction to get those initial deals done, so that then we can build on everything else. Like financial services, healthcare is a notoriously long, slow sales cycles. Like, how do we build up to that without, by generating revenue in other areas, without running out of money trying to get a large deal done at JP Morgan or Bank of America or whatever. So it's an interesting inverted challenge, and we resource our team based on those things. And yeah, it's there are lots of repeatable sort of things that we see, but everybody kind of has their own unique challenges at different times.
Yeah, super interesting. It sounds like you need to, you have your frameworks, but you need to there's no replacement for actually doing the critical thinking about each of the opportunities that make it into your, but you said about 50 companies that make it to that light diligence phase. I'd love to talk now about the segment of the fundraise cycle from, okay, you've had a good first meeting with a company and you'd like to progress them in further into your deal funnel. You mentioned you have a partner meeting coming up on Monday. Could you just speak about what that internal decision making timeline looks like and what your diligence process looks like for companies that you want to learn more about?
Timeline, I think we've probably done it as realistically, as fast as 3 or 4 weeks. It's quick to get to know founders, especially if we're going to lead around, join the board. These are long relationships. We have founders we've been working with now for 7, 8 years. So I think 3, 4 weeks is fast. Definitely saw a lot of that, and even faster rounds during the bubble days of Venture 21. I think most of the time for us, it's around 60 days, realistically, to kind of get through everything that we want to do, get to know the founders a little bit better, and come to our own decisions. Because I think because of our experiences and having been hands-on in this world, we can sometimes be kind of contrarian investors where we probably pass on things that other VCs would jump on because of the momentum or whatever else. And we just have to build conviction on our own because we're not a multi-billion-dollar fund that can, sustain a company that's raises a $3 or $4 million seed round for a bridge on our own, right? So we have to really think about what it is we're getting behind, what the capital intensity of that business is going to be like getting to a Series A, let's call it. And do we think that we can bring enough capital like with us in the round and then get it to a point where our network of Series A investors and beyond will get it and want to take a look at it.
What does it take for you to get to that level of conviction? What does the internal process look like?
Yeah, I mean, I'll tell you, we have a checklist that we call our success factors. We give everything a rating. Basically covers 4 key areas, and we put a lot of work into each of these questions, trying to understand them and score them to the best of our abilities. And we just start filling that out from kind of day one of like, what do we think we know? And we have a weighted, we treat it like a typical, I can't help being a washed up sales guy. We have like a weight as to how confident we are about our score. So we have a score, an unweighted score, and we have a weighted score for each company. And it covers, market dynamics, team dynamics, sort of the other product, technology, business characteristics, and then the funding part of it. So we have a threshold that we think is right around the mark, where if it's over that, we should probably get to a yes. If it's under that, we should get to a no. But it's also just, along the way, it's just a trade-off of resources. Like, do we feel like we're getting to a point where it's worth continuing to dig and learn more? And, we typically know, like I said, within at most, something gets into the process, within 2 meetings, we know if we want to spend time on it or not. Because at that point, me and the team that focuses more on the business, MBA, business models style thinking around it, have gotten on board or not. And then if we are, then it's usually, David and the tech side of our business coming in and being like, yeah, these guys know what they're doing. This will scale, or this is where we're going to have tech scaling challenges over time. And it's pretty efficient. Like that the first couple of meetings are like super efficient. Then once we get through that, then we have to put together the work plan.
Interesting. You mentioned your success factors. What would you say is the single biggest success factor you look for in seed stage startups as having the highest positive prediction of future success?
Yeah, I mean, we've looked at this quite a bit. So far, it's still just founder background and how well it lines up with the problem they're solving. Call it founder market fit. That still seems to be the key. And with that is like take that one step further is that if we have a founding team has a strong business leader, whether it's a CEO or COO or CRO, whatever, on the founding team, that is very action oriented. Typically, if they've worked from call it Series A company and scaled a bit, that's the best case scenario because they can usually come in. It's helpful to have CTOs who have worked early stage, at least founding team early stage. It's not as critical as the business leader, that trying to figure out how to scale from nothing. What's always so appealing, and it always takes some extra poking and diligence to really get to the bottom of, is like people who are super successful, big company world, have amazing Rolodex, come into startup land, and unless they've really been in a startup within the last 5 years or so, they don't have as easy of a time getting going. Tech team are usually pretty good. They tend, engineers kind of like to be on their own doing their thing for the most part anyway. So they tend to be a little bit more flexible in terms of what we tend to call stage fit per person. I think it's just something we look for in our founders, and something we also help our founders with as they're thinking about recruiting for their next key hires at each stage of their development also. So yeah, I mean, of all the things we look at and everything else, like that's still number one indicator if somebody's going to be successful.
We see the same thing at airCFO all the time when we get a CFO who comes in from a larger company or from an investment bank to an early stage startup. It's a completely different beast. And those people do often struggle to adapt to the reality of the early stage environment where you don't have a lot of support. You got to figure a lot of things out on your own. You got to be able to roll up your sleeves and do the execution. There's no time for like pie in the sky strategizing at an early stage startup. It's mostly about execution. So I could definitely see that being maybe a negative indicator from an investment standpoint.
Yeah, it's uncomfortable. It's unnatural. It's a crazy thing to do to go to a startup.
So I want to be conscious of our time here. Love to talk about what happens after you write the check to the startup. So you've winnowed it down from 5,000 to 10 companies a year who invest or who take investment. How involved does Differential, or what does your involvement tend to look like for those portfolio companies who you end up investing in? And how do you want to see updates from a portfolio company? What are the metrics or the types of updates that you expect?
Yeah. So I find that like speed is key. During the kind of courting phase, diligence phase, and then negotiating term sheet and finalizing docs or anything like that is a good time to get to know each other. There are some uncomfortable moments along the way of negotiating, but we put a term sheet out. First thing we always say is like, we've bought into the vision up to this point. We'll get through our, negotiation here. And then once our money's in your bank account, like we're all on the same team, just solving problems, right? We usually hit the ground running pretty quickly once the money's in the bank. So we tend to get on, kind of rule of thumb, usually we get on bi-weekly cadence of one of us on the team meeting with the founders. Sometimes monthly, depending on the situation, but usually bi-weekly in the early days, and just start getting them set up. Like what are the top things we're trying to solve for? Who in our network do they need to know? Start getting prepared for how are you going to start preparing board meetings, and what data are you going to show to your investors and your board? Because I think if we can do nothing else for a company, like the number one thing we should be able to do is like just start to get the company in good shape to get on and stay on that venture track over Series A and beyond. Hopefully we'll be in a good spot to introduce them to future capital and everything else, which usually we can. But at least getting the fundamentals in place where it's like you can kind of talk the talk of what VCs want and need to see and hear, and just make Series A investors' life a lot easier when they're trying to understand you. Formally, we do quarterly board meetings without fail, and we use Omni for kind of metric tracking. So each quarter we get financials, cap table, and we send out a survey, KPI survey to all of our founders. We track it in Omni. It's a great tool. We're looking at definitely, it varies a bit over time and by segment, but for the most part, we're looking at ARR, MRR, growth, headcount, customers, churn, gross margins, pretty standard stuff. And then any other calculations that we want to do on the back end, we tend to export into Excel or Airtable and do that work on our own. So it's pretty straightforward stuff. A lot of times what we see seed stages is like managing, expecting, understanding churn, and figuring out where we are in that cycle. Like in the best case scenario, companies just kind of, get it right from the beginning. But a lot of times, companies are learning through their first few churned customers of why they are not the right fit. So getting our arms around that is super important for us.
Oh man, there's so many directions that I would love to go, but we have to wrap things up here. I'd love to end with this question. What is the misconception that you most commonly see founders having about the fundraise process that you wish you could put on a billboard over in San Francisco or in New York City to help your pitches go more smoothly?
That's a great question. I think the honest answer to that is like, don't be overly paranoid. There aren't many investors out there who are actually bad actors. And there aren't very many at all that have the time or energy or desire to like hear your idea and then go give it to somebody else or back some other team doing something. Like we're doing research, trying to understand the market and who's doing things differently. Nobody's really looking to screw anybody else over for the most part, right? I usually say like 10% of investors are really value adding, can get stuff done. 80% are do no harm. They come in, they do what they're supposed to do. They listen, they talk when they have value to add. They're quiet when they have nothing else to say. And I value that a lot. And then there's 5 or 10% that are either disruptive because they can't get the shit done they need to get done. They're unresponsive, or they're actually just kind of scumbags. But it's a very low number. So I would say take a leap of faith. Don't overthink it too much when you're sharing information and stuff like that. It'd be bad for our business to screw anybody over in any way. Yeah, I'd say take a leap of faith. Just talk. You never know what something's going to lead to. Most VCs just want to help because most of the time we're just sitting around saying no. So we can actually do something helpful for somebody, whether they're in our portfolio or not. Usually happy to do it.
Yeah, the most consistent through line that I've picked up from conversations with founders and VCs is how relationship centric the fundraise process is. And I think that tracks really well with what you're saying, which is, you do have to some extent give people the benefit of the doubt in the early stages of building a relationship. And you need to be willing to take that leap and be a little bit vulnerable and see, how the other side responds. So I think that's really great advice that could help fundraising conversations go more smoothly overall.
Trust but verify, right? That's what everybody's doing during the early days.
Yeah, absolutely. Nick, thank you so much for taking the time today. It was a really awesome conversation. I'm sure that our team took a lot of insights out of it. And I'm really excited to share this video with our founder network and the broader startup ecosystem so that they can get a little bit of inside intel on what investors are looking for throughout the fundraise process.
Great. Thanks for having me.